Watch the CEO sign the order to seize 10,000 deposit spreads. This maneuver funnels $400 billion into a secret offshore. But why does your mobile? They utilize asymmetric information exploitation to transform your hard-earned security into leverage for a ruthless power play. You are the primary fuel for a massive wealth transfer that effectively shorts your financial future while the bank celebrates another record-breaking year. Inside the glass towers of Wall Street, the most powerful tool isn't a complex algorithm. It is the net interest margin. Think of it as a clinical extraction of value. As of the first quarter of 2025, the average net interest margin for large U.S. institutions sat at 2.57%. In the Machiavellian reality of corporate finance, this spread is the difference between the pittance they pay you for your deposits and the high interest they charge when they lend that exact same money back to the public for mortgages and loans. While they offer you a national average of a mere 0.61% annual return on your savings, they are simultaneously charging an average of 22.3% on credit card debt. This is the ultimate leverage play. Since March 2020, the Federal Reserve reduced reserve requirements to 0%, meaning banks are no longer required to keep your money in a vault at all. They are legally permitted to lend against your entire deposit base to maximize their own profit margins. You are the supplier of their raw material, cash, but you have no seat at the table where the profits are distributed. They use your liquidity to fund their own expansion, all while you incur the opportunity cost of inflation. The bank has turned you into an unwitting venture capitalist for their own business, except you receive none of the upside and all of the systemic risk. By maintaining this asymmetric information bridge, they ensure the organizational hierarchy remains intact. They remain the masters of capital, and you remaining the source of it. Imagine a digital interface designed not for your convenience, but for your capitulation. This is the realm of digital dark patterns, an asymmetric information play orchestrated at the highest levels of corporate architecture. In the boardroom, these are not described as deceptive tricks. They are quantified as high-velocity revenue optimization streams. According to CFPB Circular 2024-01, major financial institutions utilize negative option marketing to transform an innocuous accept button into a binding enrollment for fee-based services that the consumer never intended to authorize. This system represents a calculated power play against your cognitive bandwidth. Consider the predatory scale of the junk fee ecosystem. In 2023, American consumers were stripped of $5.83 billion in reported overdraft and non-sufficient funds fees. The industry's apex predators, specifically JP Morgan Chase and Wells Fargo, each extracted over $1 billion in overdraft revenue. This is not an operational fluke within the organizational hierarchy. It is a fundamental pillar of their retail profitability model. But there was one detail that didn't make sense, and no one noticed it yet. The psychology behind this extraction relies on a specific maneuver known as the negative option trap. This is a commitment and consistency trap where the bank frames a high-cost liability as a protective service. When you are prompted to opt in for overdraft protection, the language is specifically curated to trigger loss aversion. They leverage the threat of social friction, the embarrassment of a declined transaction, to secure a $27 fee on a $5 item. The strategic ambiguity embedded in their digital interfaces ensures plausible deniability while they harvest these margins from the unsuspecting. Even the regulatory battlefield has been terraformed to protect the dynamics of the board. Following the April 2025 judicial ruling that vacated the landmark rule capping late fees, banks were legally permitted to resume charging safe harbor limits of $32 to $43 per incident. They are not merely keeping your assets secure, they are weaponizing your behavioral biases to ensure a vertical flow of capital back into the institution. In this tactical breakdown of professional dominance, your oversight is categorized as a primary profit center, and your psychological fatigue is the bank's most valuable asset. The monthly credit card statement is not a financial document. It is a meticulously engineered psychological battlefield. When you open that statement, your brain immediately hunts for a reference point to simplify the complexity of your debt. This is where the bank deploys the most effective cognitive trap in modern finance, the anchoring bias. By prominently displaying a minimum payment amount, often a tiny fraction of your total obligation, the bank sets a psychological floor that drags your expectations downward. You might see a $5,000 balance, but your eyes are magnetically pulled to the $65 minimum. This is a deliberate power play designed to manipulate your decision-making. Research from NYU Stern School of Business proves the lethality of this maneuver. Roughly 29% of cardholders pay less than they otherwise would because they've been anchored to that lower number. In the cold calculus of the boardroom, your cognitive bias is a profit center. Everything they believed up to this point was wrong. They aren't providing you flexibility. They are securing your long-term subordination. The bank knows that as of November 2025, the average credit card interest rate has climbed to a predatory 22.3% APR. By anchoring you to that minimum payment, they ensure your capital remains trapped in a high-interest cycle, while they earn a massive spread against the measly 0.61% APY they pay on traditional savings as of December 2025. This is the weaponization of human psychology to create revolving debt. The aim is to maximize your lifetime value, CLTV, by preventing you from ever reaching a zero balance. They frame the minimum payment as a convenience, but in reality, it is a functional loss aversion trap. You feel the immediate relief of keeping your cash today, entirely blind to the catastrophic cumulative interest you will forfeit tomorrow. They have calculated exactly how many thousands of dollars in interest they can extract before you realize the game is rigged, using the safe harbor late fee limits, which a federal judge allowed to remain at $32 as of April 2025, as an additional threat to keep you compliant. That minimum payment box is the hook they use to keep you on the line. They aren't helping you manage your budget, they are managing your surrender of future wealth. The bank's most effective weapon isn't a high interest rate or a flashy marketing campaign, it is your own psychological inertia. They have built what we call the friction fortress. It is a masterpiece of dark business psychology designed to exploit the status quo bias, our natural human tendency to keep things exactly as they are, even when the current state is actively draining our wealth. In boardrooms from Charlotte to Manhattan, banking executives analyze your behavior with clinical detachment. They see a staggering gap that they intentionally maintain. In 2025, research from RFI Global and the Kearney Banking Study showed that while 25% of American households explicitly considered switching banks, only 6% to 10% actually moved their money. This is not a coincidence. It is a manufactured outcome. The tactical reality is that banks don't need to lock the doors to keep you in. They just need to make the handle feel impossibly heavy. They manufacture psychological switching costs by inflating the perceived difficulty of moving your financial life. They want you to dread the administrative friction of re-linking direct deposits or updating your recurring bills. This is a cold power play involving asymmetric information. The bank knows that modern technology has made switching accounts a 15-minute task, but they spend millions in marketing to ensure you believe it is a week-long bureaucratic nightmare. By keeping you in a traditional savings account, earning the national average of 0.61% APY, they prevent you from migrating to competitive high-yield savings accounts offering 4.60%. From their perspective, your hesitation is their profit margin. Every day you remain inside this fortress, you are reinforcing their bottom line. Within the organizational hierarchy of a megabank, you are viewed through the lens of customer lifetime value, or CLTV. They know that once they have anchored your direct deposit, they have successfully captured an average of $640 in future profit from your accounts. They are betting on your perceived friction to keep you from realizing that you are essentially paying a laziness tax of thousands of dollars in lost interest every single year. This is a game of strategic moves and silent captures, but the most devastating revelation was still to come. This calculated use of human inertia is the ultimate leverage the bank holds over your capital, ensuring the fortress walls remain tall without ever having to fire a shot. To execute the great reversal, you must stop viewing yourself as a customer and start acting like a hostile shareholder performing a clinical audit. The bank relies on your compliance to maintain their net interest margin, but you can collapse that profit engine by weaponizing asymmetric information against them. Your first move is to deploy loss aversion framing. Rather than looking at what you might gain by switching accounts, calculate exactly what you are losing in cold, hard numbers. When you see that a traditional savings account paying a miserable 0.61% APY is effectively a tax on your inertia, the psychological pain of staying put finally outweighs the perceived friction of leaving. You must immediately migrate your liquid capital into high-yield savings accounts, offering 4.35% to 4.60% APY. By doing this, you are effectively performing a strategic divestment, stripping the bank of the low-cost deposits they use to fund their high-interest loan portfolios. Next, you must engage in the customer valuation negotiation. Every time a bank representative attempts to levy a junk fee, remember that you hold the leverage. To the bank's internal algorithms, your account represents an average of $640 in remaining lifetime value. You do not ask for a favor, you dictate terms. State clearly, I am currently evaluating more transparent online-only options with zero maintenance fees. I expect this fee to be waived to retain my business. This is a power play that flips the script on the organizational hierarchy, forcing the bank to choose between a small fee and the total loss of a revenue-generating asset. Furthermore, you must aggressively de-anchor your debt repayment. Ignore the minimum payment box on your credit card statement. It is a psychological trap designed to keep you in a high-interest cycle. Instead, automate your payments to clear the full balance every cycle, essentially using the bank's own credit systems for free while harvesting their rewards points. But the ultimate reversal is the total abandonment of the big three infrastructure in favor of credit unions or neobanks. By moving your direct deposits to institutions where the spread is returned to the members, you are performing a personal corporate restructuring that renders the traditional bank's predatory tactics obsolete. You are no longer the prey. You are a disciplined manager of capital who understands that in any financial transaction, if you aren't the one dictating the margin, you are the one paying for it. The boardroom is a battlefield, and your bank account is simply the first front in a much larger war for autonomy. If you don't know the rules of the game, you're already losing. Subscribe for more breakdowns of corporate power psychology. Tell us in the comments, what's the most